Well, 3 weeks ago, the Fed met, and a downbeat meeting it was for policymakers who noted stronger than expected growth in the economy and that there had been slower than expected progress on disinflation. And now they were faced with the uncertainty of the bank situation in the U.S. Quote, many participants remarked that the incoming data before the onset of the banking sector stresses had led them to see the appropriate path as somewhat higher than their assessment at the December meeting. Remember, that was 5.1%. That, according to the minutes. Then some members said they had anticipated coming into this meeting requesting a 50 basis point move. Now, though the banking system remained quite strong and resilient, that's a quote, banks were likely to tighten credit conditions, and that would weigh on growth, on hiring, and on inflation. In fact, the Fed staff noted that the banking issues had changed their forecast from subdued growth the rest of the year to a mild recession towards the end of 2023. The problem for policymakers was, quote, the extent of these effects was uncertain. Participants saw risks to the economy to the downside, and they saw the risks of inflation weighted to the upside. Given that uncertainty and the stickiness of inflation, all participants ultimately decided, and this is not just voters, but all participants, they should raise the target rate range by a quarter percentage point. Some considered a pause, but decided banking system developments had calmed enough that they could risk another increase. But remember, they did suggest that one might come in the statement that came out of this meeting.
Well, Mike, that was the headline that jumped out to me, the fact that all Fed officials backed a 25 basis point rate increase at last month's meeting. That's a bit surprising that there was no dissent at all, because if you remember what Wall Street was thinking heading into that meeting, there were calls that the Fed was going to pause altogether in March. Now, as we read through these minutes, it's clear that that was not the case.
Much of the minutes are taken up by the discussion about the banking situation. They returned to it over and over again and ultimately decided that basically what the Fed and the FDIC had done had calmed the waters enough that at this point the dangers of inflation outweighed the dangers that could come from a renewed bank problem or tightening of credit standards. So they decided to go ahead with this move, but leave the option open for pausing in the future.